Right now, you're not getting paid at all for that risk. In fact, we have some of the lowest risk spreads right now between junk bonds and risk-free treasuries on record.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart, welcoming you back here at the end of another week. Joined as always by my good friend, the gratuitous Lance Roberts. Lance, how you doing?
I'm good, and I'm very grateful. I'm grateful to you. We're actually recording this the day before Thanksgiving, so very grateful to you this year. We've had a great year. Well, actually, we've had a great couple of years doing this every Friday. So I'm very thankful for that. And again, as we go into the Thanksgiving kind of holiday, by the time you see this, it'll be post Thanksgiving, so it'll be over, and that's why I have Christmas behind me. But very thankful for everything we've gotten to do together over the last few years. It's been a good ride, so I'm looking forward to doing it next year.
Good. It has been a great ride, and Lance, yes, right back at you, brother. I'm very grateful for you being willing to do this with me every single week, rain, shine, Thanksgiving, Christmas holidays, whatever. I hope you have, well, by the time everybody's watching this, I hope you've had a great Thanksgiving. Everybody watching, I hope you've all had wonderful Thanksgivings. Yeah, I think we can be very grateful. I'm certainly very grateful for, as we have just passed the 1 year milestone here with this new Thoughtful Money channel, how well things are going, the wonderful feedback we get from you, the audience. And yes, hopefully we'll just have the whole party continue for, as many years as Lance and I are willing to get up and do this every week. All right, brother, look, we got a lot to talk about here.
Wait. This is Wednesday, right? This is the day before Thanksgiving. Most important announcement. This is the day before Thanksgiving, so you set your scale back 10 pounds today. They go back to regular weights in January. So there.
Exactly. They go back to regular weights. Everybody gets on and realizes how much weight they've gained, and then they rush off to the gym, right? And they buy that gym membership that nobody uses, right?
Exactly. I used to build gyms in my earlier life. I used to build big, 13,000, 15,000 square foot facilities. And that gym business is the greatest business on the planet because you can sell way more memberships than people will ever fit into the gym because they never come. And you just keep collecting the money.
We've talked about this, and recently, the Gen Zs that are health focused, they've really kind of adopted the gym as their, let's get off Tinder, let's actually get to the gym, let's meet people. We've all seen the folks there filming themselves, but the issue is that these gym chains are now like, wait a minute, they're all showing up. Our model depends on people signing up and then not coming. There too many people are coming here.
Hey, but on the good side, at least the Gen Zs get out there and meeting people in real life, right?
That's such a high quality problem. No, I totally get it. Yeah, I'm right. I'm totally cheering it on. All right. Well, look, we folks, this may be a little bit of a shorter video than normal, just because Lance and I are heading off to our respective Thanksgiving festivities with our families. But there's still a fair amount to talk about. Stocks have kind of had a little bit of a wild ride here of late, Lance, up, down. The day we're talking here, they just cracked above, the S&P just cracked above 6,000 again yesterday. As we're talking, it was sort of deflating a little, looked like it maybe might break through 6,000. I'm not sure where it is the second here we're talking, but it has ping-ponged around a fair amount. I know you've basically been warning us to expect some of this volatility as we head into the end of the year here. I believe you still think that while stocks could trend down a bit between now and mid-December, you still think odds are Santa Claus will show up. We'll have that Santa Claus rally, and the year will more likely than not end strong.
Yeah, and there's really nothing to that backdrop that's changed so much. Again, you have $6 billion a day in buybacks still going right now. You've got a lot of performance chasing by the markets itself. I mean, investor exuberance is very, very elevated. And it was interesting, on November the 20th on our radio show, I was talking about MicroStrategy, which is the company, Michael Saylor's company, that buys, Bitcoin using convertible debt, which is just a massive leverage play on Bitcoin. And I was just, and this thing had gone just straight up. And I had warned, I said, be real careful here. We're seeing a lot of speculative activity in stocks like this, and that typically, doesn't turn out well. And I mean, literally the next day, the stock was down like 30%. So, we're seeing those signs of excess exuberance, but that kind of market chase is very normal when you've had just really 2 years in a row. We've had 2 years in a row of above 20% rates of return with no real consequence for just being invested. Yeah, there's been a little bit of volatility along the way. We've had some 5% corrections that we've talked about. We've had some 8.5s along the way, but nothing really consequential. And so investors are becoming very emboldened just to throw money at the markets. In fact, this year, it was kind of surprising. This year, we've had and this is year to date, we've had $913 billion flow into ETFs. And as we talked about before with ETFs, it's kind of the mindless robot. You throw your money into an ETF and then it buys all the underlying stocks. But that is the most money on record in the ETFs. The only other period of time where we saw that much money, was close to 900 billion, was in 2021. When we shut down the economy, had sent checks to households, shut off, debt requirements. You didn't have to pay your debts, didn't have to pay your rent. We were sending out PPP loans. The Fed was at zero interest rates, doing 120 billion a month in QE. You would expect that kind of flow of money into ETFs in that type of environment. But again, now you've got interest rates are elevated, the economy's slowing down here a bit, and we're seeing that same type of really bullish exuberance in the market, and it's quite phenomenal. But that is a tendency that is going to continue to propel into the end of the year, because there's a lot of managers that are behind the curve right now. They need to play catch up for the end of the year. So again, between buybacks, performance chasing, window dressing, all that, yeah, that story for an end of the year rally, that Santa Claus rally, is still very much intact. But again, you're going to have this mutual fund distribution in the first 2 weeks of December, so just be aware of that.
Got it. All right. So Lance, your firm at the beginning of every year, you guys put out a target for where you think the year could end. This year, your target was 6,000. We hit it. You talked about how you're not going to change it during the year, but you did poll your audience, and you talked about it wouldn't surprise you if we ended at 61, 6,200 or so on the S&P. We'll see if that happens, but it sounds like you think we'll probably end higher than where we are right now. Let me put you on the spot here. Not going to hold you to this at all, but you just said we've had 2 years of 20+% gains in the market. Rare, even rarer to have a third year that high. And I've talked about my analogy in the past of people who get used to their team winning the Super Bowl and then they assume they're going to get a three-peat, and the odds of that are so low. What is your gut telling you about how the market's going to perform next year?
Okay, so the answer is I don't know.
Well, of course. I'm just going to ask you to guess. I'm not going to hold you to it. Yeah.
Let me do it this way. Rather than saying, here's my guess, it's going to do this or that, there's a couple of things that are on the horizon that are a risk to the markets. And if those don't happen, the market should do fine. So let's, first of all, historically speaking, we're having one of the best years since 1928. This is, of course, immediately everybody goes, well, you know what happened in 1929? Stocks crash, right? And so there's always that, right? But yeah, we're having a very strong year right now. There's only been 6 other periods in history going back to 1900 where you had 20% plus years back to back. Out of those 6 periods, 4 of them were positive in the third year, 2 of them were negative in the third year. So, you've got roughly a 66% probability that based on that history, next year would be positive. And of that history, the average return turned out to be about 12%. So a couple of years were greater than 20. In fact, one was like a 30% return year in the third year. A lot of them were a lot lower, and that's how you get that average of 12. So again, momentum, here's the thing, momentum is a very tough thing to kill. So if not, and this is why I kind of gave you that caveat to start with, and I'll tell you why I have this caveat sitting there. Barring nothing changing, right? If everything kind of stays the status quo, the Fed keeps just kind of cutting rates here, and most importantly, earnings have to come in close to expectations, and expectations are pretty high right now. So if earnings come in close to expectations, the Fed kind of keeps cutting rates, you don't have a recession, you don't have any of those things, it's very likely this kind of bullish momentum will continue, and you'll have a return year next year of somewhere between 8 and 12%. And that'll be very disappointing after 2 years of 20, but an 8 to 12% return is, not, it's not a sharp stick in the eye, right? I mean, it's
Yeah.
there is one thing that really concerns me about next year, which is basically some of the things that President Trump is talking about, which are, and I think we talked about this last time in last week's show, talking about the Department of Government Efficiency. Scott Bessent, who is the new pick for Treasury Secretary, he is a fiscal hawk. He is all for reducing the debt and the deficit, which is great economically, long term, fantastic. All on board with it. I think it's something we should do. The risk you run is you do things too quickly, and if that and government spending, and more importantly, deficit spending, is a big driver of corporate profitability, which right now corporate profits as a percent of GDP are at an all-time high. So, in that environment, I've got an article coming up on Tuesday. We'll have an article on the collective profit equation, which explains this in detail. So you'll be able to actually read all the math. But if they move too quickly and some of the agenda that he wants, it could impair corporate profitability, slow the economy more than expected, impair earnings, and that leads to less profit growth. That's going to reduce expectations for markets. And again, with markets, valuation-wise, very extended, that could trigger a market reversion. Now, again, I don't want anybody running off going, "Oh, Lance just said the market's going to crash." I'm not saying that at all. But, we could have a year where the market's down 10, 15%. We just had one in 2022, right? So again, you just got to go back to 2022. It wasn't the end of the world unless you owned stocks like MicroStrategy that were down 90%. But if you just owned S&P, good dividend yielding stocks, it wasn't a terrible year financially, even though markets were down, 19% at the end of the day on a total return basis. But you could expect that if we have the administration move too quickly. And so that's going to be a real fine thread what am I trying to say here? That's a real fine needle that he's trying to thread. And I think that's the risk. I think you can't set that risk off entirely in the market we've got right now.
Okay, so we're going to talk about a couple of things in a sec. And an interview I did this week with Art Laffer, who has been an economic advisor to many different presidential administrations, both Republican and Democrat. Lance, you're always saying, "Hey, let's try to look on the optimistic side of things." I mean, this guy is drinking sunshine all day long, so he could not be more optimistic. So we'll talk about that in a second. But one of the reasons why I asked you to kind of postulate about where markets might go next year is I think there's sort of three factors to keep in mind here. One is when you're having years like we're having, especially when it's multiple expansion, that is primarily in the driver's seat, not earnings growth, right? What you're doing is you're pulling tomorrow's pricing into today, right?
Right.
So you get to a point, you can't do that forever. You get to a point where the market says, "Look, we've just brought way too much into today," and then your future returns become disappointing, right? And we've even seen, even Goldman, relatively recently said, right, we might only have 3% returns on average for the next 10 years, right? So, even the mainstream Wall Street firms are starting to issue, some cautionary tales about this. So we don't know when, but we could very well hit that point where we just get to, okay, we were market partied above its means for a while, it's going to have to party below them for a while, right? Secondly, I think the more you are overpriced, you pulled too much in. You do a very good job of saying, look, valuations are a terrible timing metric, so don't let the valuation itself make you think, okay, this is all going to correct tomorrow. But it makes you more vulnerable. It makes the market more vulnerable to factors that could lead to a repricing, right?
That's right.
Just like, and I talk about, you pile sand up in a pile, grains of sand. the steeper the pile gets. You don't know exactly when it's going to slump, but the steeper it gets, you know that a slump is more likely, right? So the market could be poised for that. Then there's some new stuff coming, and you just introduced one, right? So forget about the standard factor of risk factors. There's some new stuff coming down the pipe, and we just don't know. And you and I talked a lot last week, so I won't rehash it all here, but a lot of what President Trump is proposing is pretty disruptive. And I think, a prudent person just has to ask themselves, hey, even if he's successful in the long run on this, can we do this without the short-term pain? Can you get the addict off of the fiscal stimulus without it going through a withdrawal, right? And of course, if you do it really fast, that could increase that odds. Funnily enough, Laffer is saying they got to be super fast. If they do it super fast, we actually won't have the withdrawal pains. So it's a funny argument. I see you shaking your head here. His point was there's a lot of this stuff that could stimulate the economy, and you got to go whole hog on it. That if you slow roll it like Reagan did, in his mind, Reagan had his first couple of years were rough, and then it finally got better. And the lesson that Laffer took from it is you've got to be really quick at the beginning. Now, who knows? We'll see. But anyway, you've got those three layers is what I wanted to basically introduce.
Yeah, I'm not sure. I'm not arguing with Art Laffer. I mean, he's been doing this for longer than I have. I'd have to actually hear what he said about what he thinks he needs to move really fast on. All I'm saying is that when you look at our economy and how much of our just even over the last 4 years, right? We've had a tremendous amount of economic growth, but where did it come from? It came from 1.7 trillion in the Inflation Reduction Act, 600 billion in the CHIPS Act, $1,500, a couple of $1 trillion to households for PPP loans and checks and stimulus and debt forgiveness and all this other stuff, and then not to mention over $1.5 trillion in quantitative easing and zero interest rates. So if you just think about fuel for a fire, right? If I all of a sudden take all the logs off the fire, I don't have any fire anymore. There's no fuel for it. And all of the fuel that we've had has been primarily government spending driven. So if you're going to reverse that very quickly, come in and fire half the government, if and we talked about this last week, if Elon wants to pull a Twitter, fire half the government. I mean, that's a huge chunk of our employment over the last couple of years. All of a sudden, you've got unemployment at 6%. Markets aren't going to like that. And again, let's back up because it just dawned on me what you just said. What Art Laffer is talking about is like we need to do this stuff really quick to stimulate economic growth. That may be true, but the markets aren't going to like it, and that's two very different things potentially.
I think that's a great point. I did ask him about markets. We didn't get super detailed into it. Just FYI, he said, I think the markets are going to do great over the next 5 to 7 years from here. But it was 5 to 7 years, and I'm sure he was talking in the average. So yeah, who knows? Maybe in the short term they wouldn't. And I also meant to say too, in terms of this week, there's something in the videos that we've released on this channel this week for everybody. So as I think I said, it kicked off the conference that we did, a month ago with, I said, look, the theme here is if you're not confused, you're not paying attention. So this week we have, Laffer just saying, look, get ready for the best time of your life, essentially. I interviewed Anna Wong, chief economist at Bloomberg. She is, I put her in the middle, and she's actually most focused right now on the employment market, and she's getting increasingly concerned about the employment data, which we'll talk about in a minute. But she actually expects it to increase pretty substantially over next year, and possibly even more after that. And then I just interviewed Henrik Zeberg yesterday, and if you want to get the story about how we're going to go into a crash, as bad as 1929 and all that stuff, you'll get that too. So we're definitely at a point where a lot of people can look at the same data and come to very different conclusions here. And again, Lance, I appreciate you being sort of our steady Eddie here every week, saying, look, who knows what's going to happen? We're going to trade the markets we have, and you've got your longer term concerns, but you've got your short-term indicators that are really helping you determine, what to do. And right now, they're generally telling you still stay in the game for now. Yeah,
and it's interesting because I've been I post stuff on X, Twitter, whatever it is, every day, and we write daily market commentary that we post out on our Substack as well. So if you haven't checked out our Substack yet, go check it out at Lance Roberts. but we try to post this stuff on a real daily basis, just saying, hey, here's what the market's doing. This is what we expect. And it's always interesting because I get these emails from people. It's like, you don't know what you're talking about. We're about to have this massive crash. And, that could very well be the case. But the problem is, and again, I think I told you I'm debating Michael Pinto on the 13th of December for a zero hedge debate.
Yep.
He's the bear. Crash is coming. I'm supposed to be the bull, so I'll play I'll play Ed Yardini for that for that interview. But it's interesting because people are just like, oh my gosh, markets are up so much, we have to crash. And that's not really the case. There's no evidence that just because markets are up and the fact that they're up a lot, that they're going to crash. And also remember, we just had a 20% correction about 24, 25, 6 months ago. So we just went through a corrective period. The market's been rallying back from that. But yeah, there's a lot of concerns. There's valuations are elevated, earnings growth as estimates are getting very up there. But companies are beating earnings. They're generating revenue. There's a lot of things that are supporting, and still we have a lot of government spending right now. We still have a lot of money from the CHIPS Act, from the Inflation Reduction Act, still floating around the markets. So there's a lot of support for the market. So that doesn't mean that it's got to crash tomorrow just because it's up. And this is one of the mistakes that investors get themselves into is they start listening to guys that's like, oh, the market's going to crash, you better be in this, you better be shorting the market, whatever, or be out of the market, just be out of the market entirely, and the market just keeps going. And that can do that. And in fact, I'm right, this weekend's newsletter is talking about signs of excess exuberance, and we're seeing that. The number of investors piling to 3x leveraged S&P 500 ETFs is just skyrocketing. I mean, the AUM flows are just going straight up. So investors are getting very, very confident in the market, and they're taking on more and more risk. That's going to work out badly at some point. This market, and don't get me wrong, I'm not saying the markets are going to go up from here forever. They are going to correct at some point. How much they correct at some point, that's a discussion for a different day, because you got to know what the trigger is. But the markets are going to correct, and everybody taking on this 3x leverage are going to have their ass handed to them. And we see this happen over and over and over again. And there'll be articles written about how some kid had $1 million. He started with $100, turned it into $1 million. Investing in 3x leverage, MicroStrategy ETFs, and now has nothing, right? We'll see those articles coming out, and whether it's a year from now or 3 years from now, we're going to see a whole rash of these articles, because that's what happens with speculative behavior over time. My job, and so I get these emails like, you just don't understand, right? You just don't understand why this is going to happen. It's like, look, my job is very simple. I have people depending on me to grow their wealth for their retirement. So I don't have the luxury of A, speculating in the markets, nor would I want to anyway. But B, my job is to try to grow money when I can and try to protect capital when markets are under pressure. And right now, today, there's no sign of any risk in the markets. And this is the structure of Tuesday's article on credit spreads. There's no sign. Yeah. And we've talked about the importance of credit spreads before. But when we start to see some of that fracture, you're going to hear me here with you. You and I are going to start talking about, hey, you know what? We're starting to see some real evidence here of cracks in the markets. We may be 3 or 4% off the highs by the time that occurs. But we'll start saying, hey, look, this is where we're really starting to see some stress to the markets. We need to be a lot more cautious here. We're reducing risk. We're cutting 25% exposure, whatever it is. We'll get there. We're just not there right now.
Yeah. So let's transition into credit spreads. And it was when I recorded the interview with Henrik Zeberg, which, folks, is coming out the day after this one. So if you're watching this, the day that comes out on Saturday, it's going to be Sundays. So Henrik, went through his parade of horribles, right? These are all the things that lead me to believe that we're going into recession and there's going to be a massive stock market downward repricing, all that stuff. And actually, like you, Lance, he said, I still think this thing's got some more juice before we hit the blow-off peak. I think he thinks it's a much more clear and present danger, this correction, than you do. But he did say, look, I'm still long in some of these speculative assets because I think there's still going to be enough of a pop that I want to try to play some of that stuff. But he said, look, that's speculative. Like it's not responsible investing. And so I said, look, and then he thinks, there's going to be a big correction and there's going to be a rescue from the central planner. So he's got this whole sort of arc, of progressions laid out for him. And I said, look, Henry, I think I understand everything that you've said, but let me just play devil's advocate for a second. And I said, look, the GDP is still growing at a pretty decent clip. We just got confirmation this morning. It was 2.8% still in the revised number for Q2. GDP now has us as 2.6 for Q4. Housing prices are still near all-time highs. Markets are near all-time highs. And I said specifically, credit spreads are super tight. And he kind of got deflated a little bit. And he said, yeah, I get it. He said, I can explain everything that you just mentioned away, except for credit spreads. And he said, and I agree that those things have to break before, any of the correction that I am expecting is going to happen here. And he basically said, look, I just think the market is mispricing risk right now. But bond market's a massive, it doesn't matter what you think, right? It matters what the bond market thinks. But he basically did, corroborate exactly your point here, Lance, which is until we start seeing those widen, it's too early to position for a downtrend. And I'll let you move on to your credit spread article in just a second. But one thing I just want to reiterate for the viewers here, and you do a good job of beating this drum, Lance, is I've been in this business long enough where, I've talked to many, many people who have very compelling outlooks about what they think may happen. And I sort of, I still find myself challenged by this, where I'll interview somebody who's very bearish and I will say, man, that person really seems to have a good beat on that. That makes a ton of sense to me. And then I'll interview somebody who looks at the same data and interprets it much more optimistically. And I'll be like, wow, they've really got a good compelling, right? And what I've learned is if somebody says, okay, so I'm really sure this is what's going to happen, you have to understand it, but you have to take it with you have to discount it with a massive grain of salt, right? Mm-hmm. So if you say, look, that makes a lot of sense, and I think I might want to actually do some planning for that potential eventuality, you're doing yourself a disservice if you're saying, I'm pushing all my chips onto that person's, no matter how compelling they are, no matter whether it's bullish, bearish, whatever. I've just seen so many smart people make really compelling arguments about what surely is going to happen, and then it doesn't materialize, or it doesn't materialize on a timeline that is useful for an investor, right? And in some ways, people might be saying, well, Adam, I mean, that's what the whole thing this channel does, is you interview people about what's going to happen. And what I'm doing is trying to give you the best view of the opportunity set so that you can take that into account in your positioning. But I'll be very clear for folks. Don't take any one person's word for gospel, and don't ever push 100% of your chips, behind one particular person's point of view. That's why we talk about hedging. That's why we talk about diversification. That's why we talk about position sizing. That's why we talk about gain harvesting and things like that. And that, you've kind of been nodding all the way through this, Lance, but I want to give you a chance to underscore this, because I know you're always trying to talk investors out of this tree where they hear one person or see one headline and say, oh my God, that's definitely going to happen.
Yeah, and especially when it comes to big macro viewpoints, I've seen a lot of articles lately about the housing market is about to crash or whatever, and this is going to be the next big event, or it's commercial real estate, or it's employment. I mean, you can almost pick your topic, right? And there's somebody who's written an article about how this is about to happen and the world's going to end because of it. And ultimately, the thing to remember as investors is that the worst of outcomes almost never happen. And I would say never happen, because they generally never do happen. They're never as bad as we think. In the financial crisis, that was a terrible event, right? And at that time, if you actually lived through the financial crisis, people were predicting that the S&P was done. It was going to zero. There was no reason for the financial market to exist because of what was happening within the markets. And of course, that didn't happen, right? The market bottomed, and then we've had this massive rally over the last, 15 years. So the worst outcomes that we imagine of things never happen. They can be very bad, and you never want to discount that possibility. Right. Go back and look at how many events historically, going back 124 years, how many of them were really bad? Right. So it's a handful, right? So it's 1929, it's 1974. It's, you can say 2000. There was a lot of assets that did really well during the dot-com bust. That was really kind of a handful of stocks in the dot-com. Financial crisis was pretty damn bad. A lot of assets really got impaired because of that. So basically, look back through history, there's like four really big events. Those happen and they can happen. And I think we have to be very aware of that. But I think betting your outcomes on that happening is a really low probability event, right? We talked about bell curves before. And
Yep.
the vast majority of event outcomes, good and bad, are going to happen within a relatively defined range. So 20% corrections to 20% advances, that's the bulk of what's going to happen. So, as investors, I think we have to plan for that. Say, look, on the upside, I'm going to generate returns in up years, and on down years, I want to try to navigate that risk. You have to go into investing. If you're investing, you have to go into this expecting to lose money sometimes, right? It's just, if the markets are down, your portfolio is going to be down. There's ways to hedge that, right? Have some extra cash sitting on the side, so when markets go down, you're not having to withdraw out of your investment account to pay your living expenses. That just exacerbates losses. Don't put yourself in a position with leverage where you're forced to sell stuff at the exact worst time. So always have a cash cushion sitting on the side that you can live off of, use, etc., when markets are declining, because you're going to lose money sometimes. But over time, you're going to win a whole lot more than you lose. And if you can navigate those downturns to some degree, and again, this is why our goal is 80% of the upside, 20% of the downside. We realize we're going to lose money when markets are down. Our goal is to mitigate that risk as much as possible, so we don't spend so much time getting back to even.
Right. And this is why I tell people, working with an active manager versus just owning the S&P and just setting and forgetting it, right? Is a good active manager can hopefully, or should be able to give over time, give you an advantage. If they don't, they're not a good active manager.
Exactly. And again, over time is the key, right? Every year it's always kind of chuckle, because every year we get this SPIVA report from S&P. It's like, last year, 80% of fund managers underperformed the index. And that's probably true to a large degree, right? But it doesn't say which managers underperformed. Is it the same manager that underperformed last year that underperformed the year before, the year before that, or is it a different set of managers? Because if you look back at some of the great fund managers over time, they've absolutely stopped the S&P 500, right? Whether it's Warren Buffett or Peter Lynch or, Sequoia funds, or, a whole variety of mutual funds and hedge funds out there have absolutely killed the S&P. Did they outperform every year? Absolutely not. Because some years small cap outperforms. If you're a large cap manager, you're going to underperform. That happens. Some years small cap underperforms and large cap outperforms. And if you're small cap, you underperform. But this is why we have to look at returns over time, not just last year, not 2 years ago. How do things perform over time? That's what you want to be looking for with your manager.
Yes, and I'm just going to underscore another key thing that you've said very often, but it's really important for people to get, is don't compare and it's hard to do this because this is easy and this is what everybody wants to do, but don't compare your manager portfolio performance versus the S&P 500 in a vacuum. Because really, if the manager's good, they're not worried so much about the S&P. What their priority should be is, how can I help you hit your financial goals by the time you want to hit them, with the biggest amount or the lowest amount of risk as possible.
Yeah.
Right. And so, if the manager is out there every year trying to beat the S&P, he may be taking on a lot more risk than you should have in your portfolio. You don't need to take on that risk, right? You're nodding as I'm saying all this, but it's super important.
Yeah. No.
Let me ask you this: so, if I'm a potential client out there looking for a financial advisor, and I want to say, I want the answer to, well, how well are you performing versus your client's risk-adjusted goals? How do you answer that question? Like, it's not like I can just go compare a number to the S&P. Like, how do I actually, compare different financial advisors on that metric?
Well, and so that's the thing, right? So the question you asked a specific question, right? How are you performing relative to your client's risk-adjusted goals? Well, the problem is with that question is that every client is different, right? Every client has a different risk-adjusted goal. Because, for instance, somebody in their 60s that have enough money in the bank to retire on, they may be wanting 4% a year. Somebody younger may be wanting 6 or 7% a year. This is why I think when you had the interview with Richard and Danny, I'm sure they talked about hurdle rates, which is your specific goal. That's your risk-adjusted goal. So you say, when you go talk to the financial advisor, the first thing you need to establish with your advisor or with yourself, right? Establish this with yourself first. What is my risk adjusted goal? If your answer is to beat the S&P 500, go buy an S&P 500 ETF. You're never going to beat the index, but you'll track it every year, right? So you don't need an advisor for that. But just realize when the markets are down 50%, you'll be down 50% with the S&P. So you've got to establish with yourself, a realistic rate of return over time. And what is that rate of return relative to what your goals are in the future? Because again, we've talked about the math of risk before. If your risk adjusted goal is 4% a year, and you say, well, if I just get 4% a year, I'm going to hit my goals. I'm going to be good. I am golden for my retirement. If I just get 4% a year, that's really easy. You and I talked about this before. 50% of your portfolio in treasury bonds, guaranteed protection of principal. You get a 2% return off a 4% yield. So there's 2 of 4 right there. I throw the other 50% in the S&P 500 to get a 2% dividend yield on that roughly. So there's another 1. So that's 3. So out of my 4% return, I lock up 3% right up front. I've only got to generate 1% a year in the S&P to get to my 4% goal. But you go, well, but I would really like maybe 5%. Okay, that's great. But you just increased your rate of return by 20%, 4 to 5%. And that increase in that 1% rate of return requires almost 100% increase in the amount of risk you got to take to generate 1% additional rate of return. So all of a sudden, you're taking on an inherently large amount of risk to generate a very incremental change in return that you don't think much about. It's just 1%, right? But the volatility in your portfolio is going to go up dramatically. And this is where you start making bad investment decisions. You bail out early. You do all the wrong things. So this is why it's very important to understand what your risk really is and how you're going to respond to that risk. One of my favorite things is when they go to other firms and they fill out these risk profile questionnaires and they go, well, what would you do if the market was down 10? I'd sell everything, or I'd buy more, or I wouldn't make any changes. Well, everybody says, well, if it's down 10, I'd buy more. Bull hockey, you will. Because let me just tell you that every client on the planet, when this market's down 10%, they're like, should we be getting out? I'm like, no, we're fine. We've hedged the portfolio, we've reduced risk, we've done this, we've done that, we're fine. Nothing to worry about. But yeah, market's down 10. You're down 2, right? Yeah. So what are you worried about? But that
Typically always says this. He says everybody's a long-term investor until they start taking short-term losses. Yeah.
And so really understanding what your risk profile is crucially important before you hire a manager. And then when you go talk to the advisor, say, look, my goal is 4, 5, whatever the number is. And look, I have people come to me all the time and say, I just want 12% a year. I go, I'm not your guy, right? You'll have to go find another firm. I'm not going to promise you a 12% rate of return because it's ridiculous. The markets can't generate that over the long term. So, these are the things that you've got to really understand about yourself personally before you hire a manager, because your manager should be working with you to meet that hurdle rate, whatever that is for you. And so our job and what we work on every year is to make sure that all of our clients' hurdle rates are met. That's our job.
Okay. So, I've talked a fair amount on this channel of the past couple of weeks of the importance of year-end planning. So we won't continue to beat that horse here, but folks, if you haven't already, like really written out what your financial goals are, whether you're a DIY investor or you're working with an advisor, I would say make that part of your year-end to-do list this year, right? Well, you've got a little bit of time, while you're sitting there in your food coma after the Thanksgiving turkey, or you've had your 5th, eggnog or whatever. Once the buzz wears off, just sit down and really just try to, clarify for yourself, what are the key, money milestones for you that you want to hit, and generally by when, and use that to come up with a hurdle rate to get a sense for how much you need to stretch, or maybe don't need to stretch that much, right, to hit, right? So very important. Okay, well, look, let's get to credit spreads, and then let's get to the TA in terms of what the market's telling you right now in the immediate term, Lance. But you just wrote this important article on credit spreads. I've talked about how even the uber bears, like the Zebergs of the world, are saying, yeah, that's a limiter for me right now. I can't be fully bearish, at least in terms of my positioning, until I see those things start moving.
Right. And this is really kind of very important, because what credit spreads tell you is what the credit market perceives as risk. And this is a crucially important point. Retail, so equity investors, right? Retail professionals, etc. A lot of their investing and a lot of their risk taking is all based on just sentiment, right? Markets are going up, so I need to be in, right? So there's a lot
of sentiment, yeah.
Yeah, so it's a lot of sentiment, a lot of just, performance chasing, those type of things. When it comes to the credit market, and I can't stress this enough, it's all about fundamentals. So, and I've explained how bonds work before, but just as an example, Adam comes to me and says, Lance, can you loan me some money? I'm like, sure. Well, first thing that goes through my mind is, well, what kind of credit risk is Adam? Is he going to pay me back? Right? What's the inflation rate right now? Because whatever rate I'm going to charge him in interest needs to make sure that it at least covers the cost of money over time, which is inflation. What is my opportunity cost in the market? What are kind of comparable interest rates and other asset classes? I've got to measure all that. And what's my default risk? What's the risk that something's going to happen to Adam within the period of time of this loan that he's not going to pay me back at all? So I got to factor all that in. So that's what goes through the mind of somebody loaning money or to somebody else. And so that interest rate has to reflect all those underlying fundamental risks. And so that's why, if you're investing in a corporate bond, it should have a higher yield than a risk-free treasury. So when we talk about risk-free yields, we talk about US Treasuries because they're government guaranteed. The government will always pay the treasury debt and you'll always get your interest payment. So it's considered a risk-free, it's the only risk-free investment on the planet, right? So that's the one thing that we measure as risk-free. Everything else has risk. It has default risk, credit risk, all these other types of, interest rate risk, et cetera, all tied into that. So there should be a spread. I should be paid more to take on like a corporate bond versus a US Treasury. So what this chart's showing you right now, and this isn't the indicator, right? We're going to get to the indicator in just a second. But this is risk-free Treasury bonds to BAA. So this is Moody's option adjusted credit spread for basically what we consider investment grade bonds. So investment grade bonds are bonds that are BBB rated or better. And so it's BBB, single A, double A, triple A. So those are what banks invest in. That's what investors invest in. Those are considered good quality bonds. This is your Apples, your Microsofts, your Metas, your ExxonMobils, your those companies, right? Those are all the companies that have investment grade bonds out there. So right now, you're not getting paid really much in addition to buying a treasury to take on the risk of potentially Apple defaulting on their bonds, which is possible, right? It's not impossible that Apple could default on their bonds. Something terribly could happen to Apple, and all of a sudden everybody wakes up tomorrow and says, I'm not using the iPhone anymore, and they're done, right? Whatever, something could happen, and it has happened in the past, but Apple says, hey, can't pay my debt. So you're not getting compensated for that. So investors right now in the credit markets are not concerned about any type of credit or default risk. So there's not much of a spread between buying a risk-free bond and buying a corporate bond. Now, as I said, though, this really isn't the indicator. The indicator is something we'll get to here in just one second. But what corporate bonds tell you is they tell you about corporate financial health. They tell you about risk sentiment shifts. And this is the thing we're talking about, right? A shift in risk sentiment. That's the important thing to this whole conversation about equity markets. And then, of course, liquidity. Liquidity in the overall market is very important. When you start seeing credit spreads rise, it's generally due to the fact that people aren't willing to loan money. That reduces liquidity. That's where things start to get real dicey in the market. So when we take a look at treasury bonds to junk bonds, this is the indicator to pay attention to, because junk bonds, oh, I forgot, this is what's normally marketed as high yield, because when I say, hey, Adam, want to buy a junk bond? Most people go, no, I don't want to buy a junk bond. But I go, hey, you want to buy a high yield bond? You're like, yeah, I'm all in, baby. Let's buy some high yield. Get that in the portfolio, right? But that's just the marketing term for junk. You're buying companies that are on the verge of default, or they have a very high default risk potential to them. And that's why they're called junk bonds or high yield bonds. Right now, you're not getting paid at all for that risk. In fact, we have some of the lowest risk spreads right now between junk bonds and risk-free treasuries on record. And what's important, pay attention to this chart. When that spread starts to increase, when the credit lenders, when the creditors start to worry about risk in the markets and they start to see a shift in the fundamentals, whether it's liquidity, whether it's default rates, whatever it is, these spreads will start to rise. And when we start to see this spread widen between risk-free treasuries and junk bonds, that is very akin to basically seeing a sentiment shift in the markets. And you'll notice that back in 1998, we began to see credit spread rising well before we got into the dot-com crash. Same thing in 2007. We saw credit spreads rising between junk and high yield and treasury bonds in 2007, well before the financial crisis. Same thing ahead of Brexit and the Fed tapering in 2017, 2018. We saw it again in 2019. We wrote a bunch of articles in 2019 talking about the repo rates, what was going on with repo and the Fed was cutting rates, but there was nothing really wrong with the market. The market's doing fantastic. In fact, we're melting up into February of 2020, and then the whole thing comes apart because of the pandemic. But you were warned about that going into the pandemic from credit spreads. They were telling you something wasn't right. And in 2021, going into 2022, credit spreads told you something's not going on good with the markets. And of course, 2022, we had the 20% decline. So these spreads tell you in advance of when market stress becomes a problem. Does that mean the market's going to absolutely crash every time? No. But you'll notice that shaded area in the background, that is the annual rate of change in the S&P 500. And you'll notice that when credit spreads are rising, the annual rate of change in the S&P 500 declines. When it's declining, it goes up. And this is simply a function that there's no perceived risk in the markets right now. So why do I want to own a high yield bond when I can get 24% in the stock market, right? This is the thesis that's going on with investors. So, pay attention to this, because when this begins to shift, that's when you want to get much more defensive in your portfolio. And that's where we start talking about, reduce your exposure to high risk assets, increase your exposure to defensive assets, review your liquidity needs, because once you don't want to get trapped in an environment where credit spreads are blowing out and all of a sudden you've got to take money out of your portfolio because you're going to be having to sell stuff at absolutely the wrong time. So, this is why you want to take right now, there's no reason to take any action whatsoever because the credit market tells you there's no risk in the markets at the moment. When it changes, the credit market will be the first to tell you.
Okay. So super important. And folks, we will be tracking this, week in and week out, if we see any changes in that. And obviously, if we start to see these rates widen or blowing out, that would be really, really big news. But your key point, I think, is just really important to emphasize for everybody. It's not only is it not flashing danger right now, it's like so bright green it kind of hurts your eyes, right?
It really is, and look, I mean, this is what I'm writing about in this weekend's newsletter. I mean, it's kind of quite baffling, just how much exuberance is in there, considering kind of just what's going on in kind of in the background. Again, you have higher interest rates. The Fed's doing QT. And everybody's acting like right now that, we just got, liquidity galore. And that's just, we just have so much money flowing into the US market from international funds. They're piling into US stocks and ETFs. Retail investors are just throwing every bit of money they have and what they're borrowing money, leveraging up. And, it's interesting. We're not seeing a big increase in margin debt because they're margining now differently. They're either buying options or they're buying leveraged option ETFs. So instead of taking it out on margin, they're just leveraging it to their own account. So everybody's like, well, margin debt's not going up. I don't have to use margin, right? Why pay the margin expense? I just buy an ETF that's levered 3-to-1. I get the same effect. So
yeah, and of course that's not gonna end poorly. It's funny. I heard something. I was talking with Danielle DiMartino Booth at the conference I was just at, and she was talking about credit card delinquencies, and they are rising. But they took a while to start, right? Or I can't remember exactly the point she was making, but it was essentially it's the credit agencies are finding themselves surprised now about how weak the consumer is. And the reason why they got caught by surprise was because so much of what would have been in the data in previous cycles is now happening in the buy now, pay later market.
Yeah.
Right. So instead of seeing, the worst of the borrowers start defaulting earlier, they weren't seeing it because those folks were all using the new buy now, pay later platforms. And
Yeah.
so once they got to the point of capitulation, and then the next level started defaulting, it kind of caught them by surprise because they were like, oh, that used to be in our radar, it's now not anymore. But similar deal here possibly.
Yeah, no, absolutely. And it's just, the market's different. And, look, this, it's just a function that, especially younger investors. And this is the kind of the sad story. And, I talk to a lot of younger investors that are out there and they're making all the same mistakes. And you try to warn them. It's like, hey, you don't know what you're talking about. You're an old guy, right? I'm like, dude, I've seen this so many times. It's just, this what is going on in the markets right now is as old as time. You're going to take a bunch of excess speculative risk, leverage yourself up 3 to 1. You're going to buy, single stock ETFs that are leveraged, like micro strategies, et cetera. They're all great when they're going up, but not understanding the consequences of leverage when it goes in the other direction is the more fascinating thing. In fact, there were some great tweets today actually coming out about, so MSTU is the MicroStrategy 3x long. And people are very upset because when it was going up, it was the 3x long was tracking the, sorry, 2x long. It's double the MicroStrategy. When it's going up, it's tracking MicroStrategy by 2 times. So if MicroStrategy goes up 1%, it's going up 2%, right? So it's doubling the return. Well, the way optionality works is when things fall apart and then rebound, you don't get people coming back in and buying the options as rapidly as they were previously. In fact, they're trying to get out of them generally. So the price appreciation has occurred. So they're talking, like, for instance, here's a tweet talking to the company that makes the MicroStrategy ETF. They're like, why isn't your 2x leverage MicroStrategy ETF tracking MicroStrategy on the rallies? It seems like it tracks good on the upside, tracks perfectly on the decline, and then fails to rally. Mm-hmm. And welcome to the world of options. And
welcome to the world of leverage ETFs, right? Exactly. I mean, that's anybody who's been in one has seen this tracking error in all sorts of different ways. Yeah.
Absolutely. And this is just because of what's called optionality. And this happens, all the time with any ETF that you use that has options in it. You have a decay of premium over time as those options get close to maturity, and the option rolls kill the performance over time. So, leveraged ETFs are great if you're day trading them, but you need to be in and out of them. If you hold them for any period of time, that decay of premium weighs into your performance.
Yep. And if you end up holding them when the exuberance reverses, it's like having an anchor tied around your neck.
Exactly.
All right. Well, look, let's get to the TA for the week. And then there's some economic data that came out. I just want to dial through real quickly with you, and then we'll start beginning to wrap up so that we can get to our respective Thanksgiving celebrations.
Sure. All right. So yeah, just technically speaking, the market really just is just doing its thing right now. We kind of drew this trend line previously when the markets were rallying off that August low. This is where people are getting 6,200 from, which is the top of this trend channel that was going up. We ran into that resistance right after the election. We talked about this last week. Held nice support at the 20-day moving average, bounced off that nicely this week. Actually set new all-time highs this week. We actually broke above 6,000. As of Wednesday, we're about 5,993. Friday, we're open half a day. I wouldn't be surprised to see this market rally a little bit on Friday, given it's a half a day, but doesn't have to. But the first 5 days of December typically tend to be pretty good because we see money flows coming in for the month of December, stock buybacks, those type of things. So again, this market could rally a bit going into next week. The following 2 weeks, we get into mutual fund distributions. So again, just kind of assume the market rallies towards 6,100 next week, maybe. Then it pulls back to maybe 6,000 again, maybe 5,900, somewhere around there. over the next 2 weeks, and then you get a rally into year end. One of the reasons we're not really moving our year end target of 6,000, I still think we're going to kind of wind up there. We might be 6,100, we might be 5,950, but I think we're going to be close to 6,000 by the time we wrap up the year.
Okay, so that actually means it's not going to move much in net from here to the end of the year.
But you're going to have, in advance a decline in advance and kind of wind up maybe again, I really don't have any idea. By the time we get to the first 5 days of January, we could be pushing 6,100 or a little bit more. So again, just but historically speaking, we tend to get this kind of volatility during mutual fund distributions, which bring the market back, and then you get a rally into the end of the year. So again, I don't think there's a ton of upside right now, but I think there's a reasonable amount that, if you're long the market, I think you could make a little bit more money by the end of the year. I'm certainly not discounting that at all.
Okay, and I'm just going to repeat what I think just to make sure I've been following you correctly, but it seems like you think chop, meaning, we can go up, we can go down until about the last week of the year, and then the Santa Claus rally should kick in for the last week of the year, first week of the new year, and then you'll see what happens after that to make your next call.
Yeah. And normally in presidential election years, the market tends to rally into the inauguration. Everybody kind of gets really excited about the inauguration. And then you typically get a decline after the inauguration. So again, you kind of have that seasonal tendency as well. But again, how this plays out, I really don't have a clue. We're just going to navigate it for what it is and trade accordingly.
Okay. All right. Well, let me just dial through some of the data we got this week, just so folks are aware of it, and then also too, if there's anything material about it, you can chime in on. So today we got some new inflation numbers. Core PCE was up 2.8% year over year. That's the Fed's preferred metric. That was an increase. So, some folks are looking at that and saying, okay, that's one of the things that's going to keep the Fed from being able to continue to cut aggressively from here. Personal savings rate was revised sharply downwards by 140 billion. I actually got an email from Lacey that I'll quote part of in just a second here. But there are we're continuing to see this drumbeat of pretty substantial downward revisions in the data that seems to make the economy look materially weaker than we were previously told. It's not Armageddon, the world's ending data yet, at least, but it is showing that the patient is sicker than what we've been told. As I mentioned earlier, we just got new GDP, updated GDP numbers for Q3. They're unchanged, basically 2.8%, which is relatively fairly robust growth for America. Q4 GDP now is showing 2.6%. That number bounces around, but it's not cratering, right? So, I know you expect the trajectory of economic growth to slow from here, Lance, over the coming years, but right now the engine's still chugging along. And then another one of those big revisions we got was, two things. One, we just got the jobless claims. We're seeing a recovery in initial claims, but that was sort of muddied by the hurricanes and stuff like that. Continuing claims, though, they've been ratcheting up month after month, and they're now at a 1.9 million, which is the highest in 3 years. And again, this isn't like at alarm bell stage yet, but the trajectory is such that I think people are looking at it and saying, okay, it actually seems like the job market, is continuing to quote normalize, using Powell's language, but I think more and more people are saying, maybe I might want to say it's starting to weaken, but we'll see. And if you want to get more about that, if you haven't watched already, watch the interview that I did with Anna Wong, chief Bloomberg economist. We go pretty deep into the employment situation. And as I said, punchline is she's not waving signs of catastrophe, but she's just saying, I'm getting more concerned about where the employment data is going, and she expects it to continue to rise from here. Okay, here's the punchline from what Lacey sent me this morning. The significant downward revision in the income components, because there was revisions to a whole bunch of other elements as well, that came down. It only reflects the lower entry point from the QECW at the end of the second quarter. The 1.2 million overshooting of payroll jobs compared with the QECW is for the period ending June 30th, 2024. If the non-farm payroll survey continued to overstate job growth in the third quarter, which we don't have data for yet, the health of the consumer sector will look even worse. The bottom line is that the consumer is much more fragile. So you'll notice in there, we got the latest QECW numbers, which have a lot more data points in terms of how data is collected than the general BLS numbers we have. And essentially what they tell us is, everybody may remember the 800,000 plus downward revisions we had in payrolls a while ago. That was for the through Q1 of 2024. We now have the second quarter data. So if you do that, the year ending that quarter, it's now more like a gap of 1.2 million payrolls, right? So that undercounting or the previous overcounting of jobs, we're learning that it's getting worse as time is progressing into the year here, right? So this is one of the things that Anna talked about with me is that when you look at that data in terms of, oh, there's less jobs than we thought, there wasn't that much of a delta at the beginning of the year ago timeframe, but the more you go into the year, that delta gets bigger and bigger and bigger. So it's suggesting that the weakness in the labor market is continuing to accelerate from here. So, big punchline is Lacey's last comment here, which is that the consumer is looking more and more fragile. So like I said, kind of a mixed bag, Lance, but I thought it was important to get all that stuff on the table because they do help us give a sense of where the puck is heading. Over what time frame, TBD, but we can sort of see these trends.
Yeah, no, that's absolutely right. And again, this is why we continue to expect lower rates of inflation as we go forward, continue to expect lower rates of economic growth, which will translate into lower yields as we go forward. Again, part of the article coming up on Tuesday on the Kaliki profit equation is that corporate profits are derived from basically investment and dividends, less household saving, less government saving. So right now, the government's not saving because they're spending everything hand over fist. That's why we have debt and deficits. Kind of, everybody's worried about the debt, the 36 trillion, and deficits at 2 trillion. That's government's not saving any money. Households aren't saving any money. They're getting further and further into debt. We just saw record credit card debt recently. Household savings rates are declining. That all feeds in. What that means is that they're out buying stuff. And in fact, you saw that in today's economic data. Personal income came in, it was up 0.6. But personal spending was up 0.4 on expectations of 0.2. So there's no weakness in the consumer at all right now. So again, they're just, and you'll see the Atlanta Fed GDP number get revised up. It'll probably be 2.8 at the next revision date after today because of that personal income and spending data. But households aren't saving any money. So to Lacey's point, and he's absolutely right about this, that is going to impede economic growth as we get to next year because simply consumers running out of money and they're 70% of the economy, and that's where corporate profits come from.
So are we just drunken sailor nation here?
Well, think about it. Look, I've had the conversation with you numerous times about there's nothing good that comes off of social media. And one of those is it's just driving Americans further and further and further into debt because, again, you're scrolling social media and there's every other thing on TikTok or whatever it is some guy hawking something at the TikTok shop. Just go buy this, here's this cool gadget. Or, there's, some person that's a social media influencer. And we've created a whole marketing, evolution over the last, 10 years of these social media influencers, and they're all over social media telling you to go buy stuff. And again, as consumers, we're impulsive. It's like, oh, I like that. And, when I don't have to go actually out somewhere, travel somewhere to go buy something, I have to reach in my wallet and actually get cash out. This is I tell my kids all the time is like, don't have a credit card. Don't even have a debit card, right? Keep cash in your wallet. And of course, it's becoming less feasible today because there's places.
I know it's getting harder and harder, but yeah, but you see what you can see when you're parting it, so it makes it more of a considered.
Forking out, $10 for a coffee that you spent a lot of time working for that $10, all of a sudden it gets a lot more real. But when it's on plastic, we lose context with what we're spending. And this is, one of the things that we look at a lot in financial planning in our firm is what's called leakage. And so we dig into your budget. It's like, how much money do you have every month just gets leaked out that you're not even aware of? It was $10 on Starbucks, it was $5 on this and $10 on that.
Online subscriptions you've forgotten about.
Absolutely. And it just goes on and on and on. And so, it's just, we developed this whole environment, this whole society around consumption, and people feel compelled to spend. It's like, oh, and again, we come up with all these mottos for it, right? It's like YOLO, you only live once, right? So I might as well spend everything today because there's no guarantee I'm going to be here tomorrow.
Doom spending, yeah.
And this is just, and this is why 80% of Americans live paycheck to paycheck. They have no money in the bank. They don't have any money in retirement savings. They can't afford to put anything to retirement savings because they spend everything they make. And the stories just go on and on and on. And then we want to point fingers at everybody going, well, it's the corporation's fault. They're not paying me enough. They're not doing this. And they're not, the country's doing this. And it's this person's fault. No, it's your fault. Look at what you do to yourself financially. Learn to live within your means, and things will get. The only person that's control over making your life better is you. And you can blame everybody else, but that's not going to improve your financial outcomes. So I'm not trying to hurt your feelings, and please don't take it that way. But I cannot tell you how many people that I talk to that their financial problems are everybody else's fault. It's not their fault that they're in this financial situation. But and then what's interesting is when you start to dig down into the budget, we say, well, what about this? And what about this? And there's always an excuse. Well, I had to because of this reason or that reason. Oh, I had to do that. Did you have to, or did you want to? Right. And this is where separating out needs and wants is so incredibly important. And I have a list. People email me. They're like, I have $50,000 I want to invest and be wealthy with. And I'm like, here's your checklist of things to start with. Fully fund your 401k at work. Once you do that, fund a spousal IRA. Once you do that, save up 6 months of an emergency fund. After that, pay off all, I have this whole list. And it's interesting because if you just follow this list, you'll build wealth. But immediately you get responses back saying, that's ridiculous. Nobody can do that. That's a general response. Or I get no response back at all, which means that they just trashed it and they're just doing whatever else. But this list is really simple. And if you just follow it, you're going to build a lot of wealth, and you will have a lot of wealth when you get to retirement. You'll be great if you just follow this list. It's very basic. It's very simple. And it's just a massive amount of savings. You're going to save 30 to 40% of your income and live on the balance. But it requires sacrifice, discipline, and diligence. And that's the one thing we don't want to accept responsibility for. We would rather say, well, the government needs to pay off my student loan, or the government needs to do this, give me money for childcare, whatever it is. But those have a higher cost to them than just doing it yourself.
Yeah. All right. So you're treading dangerously close to where I want to take today's rant. So we'll dive further into this in just a minute. Okay. But, so there are a lot of things so I totally agree. Like, this victim mentality totally works against us, right? You got to be your own hero in your own story, right? And be the one to do the big and right things. But there are a lot of kind of headwinds that we have in this situation to building wealth like this. One is evolutionarily, right? In general, we're wired to maximize our situation now, right? So you see the tree that's got a bunch of fruit on it. Eat all that fruit, get those calories in right now, right? I mean, that's sort of what your inner caveman primate is telling you to do, right? Secondly, our education system is terrible at teaching financial literacy, as you and I have talked about many, many times, Lance. Obviously, we don't have a good example being set by our, government and elected leaders. They're even bigger drunken sailors, as you mentioned. And on the corporate side, you talked about social media. I agree with everything you said. I actually, though, I think even worse than the influencers is your own friend group, right? If you're on Facebook, everybody is sharing the perfect moments from their lives, right? So you see your friend, your college roommate, whatever, and they're on the beach at Aruba, or they're on the whatever, right? And you just, it makes you think, well, my life sucks, so I got to do a little bit about what they're doing, right? And that's where that, compulsion to spend and keep up with the Joneses comes from. All right, but look, we'll get more into that in a moment. Couple of things I just want to note for folks. I want to give a quick recap of the conference I was at. But real quick, there was a story that caught my attention. I just wanted to share it here. So you said, we're not seeing a slowdown in consumer spending, so there are no signs that the consumer is in trouble. I mean, obviously, all the other signs that the consumer is in trouble, right? I mean, the decline in savings rates, the default rates, the amount of debt they're taking on, the record amounts of debt interest they're paying. I mean, just yada, yada, yada. but this one really caught my attention. Um, Food is becoming so expensive in Canada that people are starting to get scurvy, right?
Jesus.
So fruit has become so prohibitively expensive in parts of Canada now that people are just not buying enough things with vitamin C because they're too expensive, that all of a sudden we're dealing with this like 17th century scourge that, there's really no good reason in today's, society that anybody should be anywhere near the line on getting something like scurvy.
Right.
But they're already starting to get that. And I mean, $20 grapes. That's how much like a cluster of grapes apparently cost, at least in the grocery stores that this Canadian article was talking about, right?
I just bought
Um,
I just bought some grapes for Thanksgiving. I don't remember what we paid for them, but they weren't cheap. I'll admit that.
yeah, yeah. So, anyways, I mean, I just want to flag it because something tells me if we continue going down this path of rising cost of living, and especially again, these are the quote unquote good times where unemployment is low, right? We get some clearing event in the unemployment market. If prices don't come down commensurate with that, we could sadly see a lot more of this type of stuff going forward. Okay, so that was on the negative side. Positive side, I was at the New Orleans Investment Conference last week, and it's always a great experience. But the reason why I wanted to just take a second to talk about it is I cannot tell you, Lance, the number of times I get stopped. I mean, sometimes I get stopped every like 2 or 3 steps when I'm trying to, walk in the hallways there by people who come up and are just so grateful for thoughtful money, particularly these weekly conversations with you, Lance. And it's honestly, it's the best thing for me, because it really just feeds my soul, because this, of course, have made this my mission in life. But what I love about it is it's not an ego thing. It's not about me. It's just people are so grateful to have a platform like this that really does try to chart the center course. I'll steal your eagle analogy there, where it's really just to be like, look, you're not pushing an agenda, you're not trying to sell a bias or whatever. You're just trying to bring on smart people and give the conversation the room and the oxygen it needs for me to fully understand what this person's position is. And a lot of people have said, I've learned so much, I didn't get a good financial education in school or at home, and I've made a lot of much better, more informed life decisions as a result. Had a lot of people come up and say, hey, I've ended up working with RIA or the team at New Harbor, and they've been great. The amount of goodwill that I get to enjoy from the audience reflecting all this back to me when I'm there it's just a true joy. It's a massive, massive pleasure and honor. And I wanted you to hear that, but I also want the audience here to know how meaningful it is to us when we hear that type of feedback.
Absolutely. No,
Okay.
absolutely. It's what it's
Um,
just, this is why I spend 2 hours with you on a Friday for free, because I enjoy doing it.
right, right. And you write as many articles every week, as much as you do. I mean, this treadmill's tough, and we're going to talk about that in a little bit of the rant. It's a tough treadmill to stay on and be consistent and keep doing this, no matter what else is going on in your world. But we do it for when we hear this type of feedback, it makes it all more than worth it. So, two other just quick anecdotes. One, I mentioned Danielle DiMartino Booth was there. I think she'd be comfortable with me saying this. I think I've known Danielle for a number of years. I think she's more nervous, or more, let me put it this way, more concerned about what lies ahead than I think I've ever seen her before. And I'll kind of leave it at that. But folks, I will work to get her back on the program relatively soon, so that you can hear the latest and her full perspective on this. But I would definitely put Danielle kind of in the Lacey Hunt camp, and she thinks that there is a lot of shoes dropping or likely to drop coming in the future that are just not going to be things that the Fed or certainly the Trump administration are going to be able to do much about. In other words, these things are just eventualities that are going to be happening to the economy. All right, so that was more on the sobering side. On the more fun side, I chaired a panel that was one of the most electric animated panels I've ever moderated, and it was really good discussion. It ended up kind of it was a panel on the future of money, It ended up in kind of a bare knuckle brawl between Peter Schiff and a couple Bitcoiners who were there. But it was prefaced by this funny little story, I'll tell you. So we were all in the green room getting ready to go up on stage, and Peter Schiff walks in and he's wearing a yellow tie. And Lawrence Lepard, who's he's a pro gold guy, but he's also very pro Bitcoin, said, "Hey, Peter, nice gold tie." And without missing a beat, Peter Schiff looked at him and said, "Hey, thanks a lot, Larry. Nice Bitcoin tie." Now, the thing is, Larry wasn't wearing a tie, right? And Peter's whole thing is that Bitcoin is just it's completely made up. It's this, it's a whole concept form out of nothing, right? So it kind of set the stage for going into the discussion. And of course, they really got at it. I actually had to bring an air horn along to try to keep people from just completely spiraling out of control in their answers. But anyways, folks, there's a chance that I might be able to get the video for that. And if I do, I'll share it here on this channel because it was a really interesting discussion. But I actually thought that was a pretty good zinger. And the fact that Peter just came up with it like that, with no advanced thought, I was pretty impressed. All right, look, we'll start landing the plane here. I got a rant before we get to it though, Lance. Trades. What trades, if any, have you made since we talked last week?
No trades this week. It's only been 2.5 days. So yeah, I mean, that's
2.5 trading days since we last talked. Yeah.
So yeah, it's nothing this week. I think we're in a pretty good position going into the 1st of December.
All right, and I think you gave a nod to this earlier, but I should just ask it. Bonds. Anything happening in bonds that's worth talking about, or just same old, same old?
I mean, yeah, that's 1 week to the next. What changed economically, right?
Yeah, I didn't ask you much about it last week, and I got the questions I always do. I can't believe you didn't talk about bonds with Lance, but I just don't think there's much to talk about that's new since we last did a deep dive.
Yeah, there's not. And again, bonds are economics. So, it's inflation, wage growth, and interest rates, inflation, wage growth, and economic growth, and those are all doing their thing right now, and we're seeing evidence that we just talked about a minute ago that those are going to slow down next year. Negative revisions to a lot of the data, negative revisions to savings, those are not coincident with higher rates of inflation. So again, that's just but in the short term, you've got bond managers that are short bonds, long bonds. They're hedging. There's new issuance coming out. Those are offsetting risk, and bond hedgers are hedging those. So you're going to get movements in interest rates kind of all over the board. But, bond yields have been doing great this week. The announcement of Scott Bessent as secretary put a huge pop into bonds this week. And so yields came down, bond prices went up. It's been a good week for bonds.
Okay. All right. Last point here is, Lance, you were talking earlier about the formula for building wealth, that it's a relatively simple formula, right? The challenge, the complexity comes in is being consistent and dedicated and disciplined, right? We've talked about this a fair amount in terms of building wealth. And yes, folks, it's absolutely critical. It's an essential part of wealth building, but it really is an essential part of hitting any life goal. The sense of discipline and applied commitment. And what I wanted to talk about briefly here is the importance of setting goals, specifically SMART goals, and then establishing a routine in your life. And Lance, you're already nodding on this because I know this is close to your heart. So, a routine, I think in general, people don't like the thought of a routine, right? It feels confining, right? Pardon me?
Best thing ever.
It is the best thing ever. And I think this is one of those learnings of as you mature, it's part of the wisdom you gain through maturity, is realizing the power of a routine. An example of it, we were talking before we turned the camera on, Lance, about our respective workout or fitness routines right now. And I've been following one of late. It's the Wendler 5-3-1 method, and there are a couple of different versions of it. And the version I'm following is called Big But Boring. And it's this routine that you follow, and it is one of these things. As long as you just get up and do it, you put the reps in, you will see continued progress over time. Again, not the sexiest thing, not a ton of variety, but it works, right? And it's funny, like when I was younger, I did not like to be pinned down by structure, right? I thought it was too confining. I thought it was too limiting. But as time went on, I realized that because I wasn't structured, I was in like permanent reaction mode. I was always just reacting to what fire came up that day or what people were asking me to do. And as time went on, I realized, okay, I'm not like any progress I'm making in this confusion and chaos is accidental. And actually what I'm doing is I'm helping the people who actually have goals and structure, who are saying, hey, Adam, I need your help on this. I need you to focus on this. I was responsible for their progress. And I wasn't progressing myself, right? And so once I learned that, coming up with a specific goal and then figuring out, okay, what are the behaviors I need to do to hit that goal over time, and then just making those behaviors a routine, it was such a massive life catalyst. I mean, I made so much more progress, so much more quickly towards the things that I cared about. And, if you're younger, this is a really important lesson. And again, it might not sound sexy, but I think it is absolutely critical if you want to be successful in hitting, the goals that you set for yourself in life. First off, start with the SMART goals. And if anybody doesn't know what I mean by SMART goals, SMART is an acronym. What is it, Lance? It's S is for specific, measurable, actionable, realistic, and time-bound. So you want to say, look, I want to be able to, deadlift 300 pounds by next June, right? And then you figure out, okay, what do I need to do between now and then to make that happen? And then, okay, how do I put that work in between now and then, right? Again, maybe not the sexiest thing, sounds kind of dull, but it's a life hack. I mean, it's really one of those things that's going to just unlock a ton of opportunity for you. And if you're older, this is something we can all improve on. And some people never learn it. My mother, not trying to slam her, but she just she never learned structure. And as a result, she had a lot of patterns that she was stuck in for decades. And it was largely because she didn't have a routine. Any given day, the universe is going to do whatever it can to throw little curveballs at you. And every time that would knock her off, whatever potential momentum she was building. And she never really fully had the awareness of that. And so she just sort of was trapped in this pattern of being frustrated at not hitting the goals or the dreams that she had. And it was because she never set a SMART goal and then never gave herself the disciplined routine to get there. So I will take a beat here, Lance, but I know in your life, with your work, with your fitness, with all sorts of things, this is something that a lesson that you've applied well.
No, it's interesting. I have everything on a calendar. And I try to explain this. Like, for instance, my wife, she's always complained. It's like, oh, I didn't have time to work out today. And I get it, right? I mean, my day is very busy. I'm constantly have things being thrown at me. Somebody wants to talk to me. Somebody wants to do this. Somebody wants an interview over here. Whatever it is, right? There's just constantly something kind of coming at me. But I have a very rigid schedule, and I don't let things interfere with that. So, I get up in the morning at 3:30. At 4 o'clock, I'm showered and dressed. I get my protein bar together. I get my protein drink together, whatever it is. By 4:30, I'm out the door. I go to the office. I'm prepping for the radio show. Radio show starts at 6 o'clock. So between 4:30 and 6, I'm tweeting, posting articles, whatever it is I got to do. 6 o'clock, radio shows from 6 to 7. From 7 to 7:30, I'm prepping for my investment policy meeting. And so at 7:30, from 7:30 to 8, we have an investment committee meeting every day with all of our advisors. We go over the markets, what we need to be doing, what we need to be focusing on. From 8 to 8:30 is my meeting with just my investment team, and we're talking about portfolios, what we need to do internally. At 8:30, I'm at the gym. We have a gym downstairs in our building, so I'll walk downstairs from 8:30 to 10. I'm working out. At from 10 to 10:15, I'm driving home, get home. But my whole day is on a calendar, and you can go through this. Every day for lunch, I eat lunch precisely at 11 o'clock because I've been up since 3:30, so 11 o'clock is my lunch. But in order to keep from straying off my diet, I eat pretty much the same thing every day. It's some form of chicken, rice, and broccoli every day. And I keep it simple, I keep it basic, and that way I'm not constantly pulled like, oh, what do I want to eat for lunch today? Oh, I think I'll swing by McDonald's or Burger King or whatever. Because when you don't have that planned out already, or have pre-made meals, etc., you're going to start, oh, I'll just grab a quick whatever it is, and now you're off your diet. You're not staying tuned to that. So the point is I have everything on a calendar. And I have time scheduled for interviews. I've got time scheduled for client meetings. I've got time scheduled for emailing, all those type of things. And as long as I stay true to that routine, I get everything done with very low levels of stress because I just have everything allocated. What happens with most people, and you said this earlier, is that we're just reactive and we're constantly getting bombarded with stuff. And it's like, oh, Jimmy needs me for this, Bob needs me for this, Christina needs me for that, whatever it is. And now we're all stressed because I've got this other stuff to do, but now I've got to go do this over here. And that's where all the stress comes from. And that's where we start getting higher rates of cortisol. We don't sleep well at night and we don't eat well, which further exacerbates our cortisol levels, which further makes us feel worse. And we're not exercising to work off that stress because I didn't have time to go to the gym today because Bob needed me for some project that wasn't even my project to start with. But, I helped him anyway, and I didn't get to go to the gym. And so this is the problem. And so when you have no structure, that's your problem going forward. Then everything else feeds off that chaos. There's an interesting fact about people in the military. You get up in the morning and the first thing you have to do is make your bed. And that's a religion with people that are in the military. And the reason is that you get up in the morning, you make your bed, you've already accomplished something for the day, right? You've already got something done for the day just by making your bed every single morning. And then when you come home at night, guess what? You had a hard day, you got a nice made bed ready waiting for you, right? Yeah. And so it has benefits. And so this is the whole point about, in the military, it's all about discipline. In martial arts, it was always about discipline. And whether it's saving money or investing, it's all about discipline. Everything comes down to discipline and routine. And if you don't have discipline and routine, you're guaranteeing yourself failure. And this is why people can't save money. They don't invest well. They become overweight. They don't feel well. Sickness becomes a habit in life rather than health. And it's because they didn't plan well. There was no routine to follow. There was no discipline, no structure, and everything just deteriorates in that type of environment. Think about a house that was built without a blueprint, built without engineering, built without architectural plans, built just kind of, how I feel like building it. How well do you think that house is going to withstand the test of time? Same thing in life.
Yeah, and just for the folks that might be hearing this and saying, oh my God, it sounds like living like a robot. I don't ever want to live like that, right? The way I look at it is I actually find it enabling in terms of the unstructured things that I want to do, because I know the part in my day that's dedicated to either high level kind of meta thinking, or that I've just said, hey, this is the part of the day for play, right? So, it actually makes it a lot easier as I'm going through a similar type of structure as you, is it requires less brain effort. Because the more I do it, the better I get at it, the more natural it feels. I've got my 10,000 hours. I'm just playing to my strengths, right? And I'm banging out all the stuff that I know I've got to do. And then the things where I've really got to problem solve, or I want to be creative and think about what's going to come next or whatever, I've got time in the day dedicated for that. And my mind can be free to do it because I know that everything that had to get done that was essential is already done, taken care of, right? That bed's already made, right? And so I can really light up that part of my life much more than I might otherwise be able to do if I'm just swimming in this sense of like, oh my God, I've got all these curveballs I haven't dealt with, and everything just seems like a morass of confusion here. So I actually think you have a wider color palette of life if you do it this way.
Well, yeah, and you do. And look, at the end of your day, if you've accomplished everything on your list, right? You've got a good sense of accomplishment. It's like, how was your day today? It was great. I accomplished everything on my list today. I worked out. I did my work. I got my job done. I did everything I was supposed to, and I'm good. And so in the evenings, I can do whatever I want to do. I'm not stressing about tomorrow because I've already gotten everything done that I'm supposed to do for today. It's done. So I know tomorrow I've got this routine ahead of me. I know what's coming up, and there's nothing to stress about. I'll just deal with it as it comes. And then there's a very important part of this. And if you can't master this one thing, it doesn't matter. Everything and nothing else will matter. And that's the ability to say the word no.
No. Yeah, I knew that you were going there. Yep.
Because again, you've got your routine. And so when people call me up and say, Lance, can you do this? No, I can't. I already have something scheduled at that time. I do have some free, I always schedule free time. I have free time in my schedule for whatever else I want to use it for. So if I want to go, hang out with my son or do whatever, I've got time in my schedule for doing that type of stuff. But that time block that's there is also for people that ask me to do stuff. And so if they ask me to do stuff, I go, I can't do that now, but I have time tomorrow at 2 o'clock that I can do this for you. And if that doesn't work for you, I'm sorry.
Yeah.
But you can't say no because that's the way you are and you have no schedule to work through. You're just going to wind up getting drug everywhere and you're not going to accomplish anything. You're going to be all stressed out and you're not going and your health is going to deteriorate. Your mental health is going to deteriorate. Your financial health will deteriorate and the outcomes are just not good.
So that is absolutely true. I learned that the hard way in life. And I think a lot of people say, I'm a good person. I want to be helpful when I can. And so if somebody asks me for help, I want to do it right. And I learned that it was actually preventing me from not only helping myself, but help. I could be of greater help to people if I got my stuff done first and then had bandwidth to focus on them. And I have a brother who might even be watching right now. This has been a massive challenge of his in his life, just the inability to say no. And he would be the first one to say it's been a really big liability. So yeah, it doesn't mean you're a bad person if you say no. You just need to be planful about it. Yeah, sorry, nope, that's in my whatever, my workout slot that's unassailable, but I do have free time over here where we can do it.
I think the most
Yeah.
valuable lesson I learned from saying no, and it's interesting because I now understand. So when I was young, I had tons of friends. Well, I had tons of people I knew that I would call friends.
Hmm.
And as I got older, I would look I would as when I was young, I was always out hunting money, doing something, right? I was always creating a business, building something, and so
Hustling.
I would go meet with rich people, and they'd say like, no, not interested. I was like, well, you got all this money, why won't you invest in this? This is a great idea. And now that I'm older, I understand them, right?
Hmm.
And it's when you're young, you have all these friends. They're not really friends. They are acquaintances. And what you find out once you start to learn to say the word no to people is you'll find out real quick who your friends are. And and this is why older people like me, they don't have a ton of friends. In fact, they don't want friends. In most cases, they want to be with their spouse and their family, and that's about it because people drain your time and they take something away from you that's extremely valuable. And I do have people that I consider to be a friend. Adam, you're a friend. So if you ever called me, I would make time for you to do whatever it is.
Right back at you, buddy.
Right. But, if Adam called me and said, hey, Lance, I need you to do this, and I said, no, I can't, he wouldn't be offended. He would understand and we would go on to do something else. But there are people that you say no to, and all of a sudden they're offended, they're hurt, they don't want to talk to you anymore. They're not really your friend. They were using you for whatever they needed you for. And now that you've cut them off of whatever that need is, whether it's financially, emotionally, whatever it is, well, they're done with you. They're not really your friend. And you're actually better off getting them out of your life.
Exactly. Yeah, I
Learning
was
to
gonna
say,
say,
learning to say no will make your life a whole lot better on multiple levels.
I completely 100% agree. All right, well, look, we'll start wrapping this up. Just a couple additional points. What brought this topic up for me to say, hey, I'll make it this week's rant is, my kids are home for the holidays, and they're getting older. Right? One just started college, one's now a year out of college, and they're increasingly beginning, because they've now been away from the home. We're empty nesters now. They come back, and we've been having these discussions where they're beginning to wake up to the fact that like, oh, actually, mom and dad, I used to not want to hang around you guys, but now that I'm here, like, I'm beginning to realize that these elements of your life are pretty good, and I want to have them in my life. And they're just beginning to realize that, like, oh, those things that I thought made you kind of boring and dull are A, valuable, and B, I just thought they came easily to you, but I see that you've actually been working on them kind of my whole life, right?
Yeah.
And fitness is one of these elements here where, my older daughter is really beginning to kind of get the light bulbs gone off. And, she is making it a bigger priority in her life, but she's realizing, she's had to go through the like, wow, it's tough to do this every day because there's always something that's trying to knock me off, the hour that I plan to do X, Y, and Z. So I really got to make it a priority, or maybe I've got to steal from sleep. Like maybe I got to start getting up an hour earlier if I really want to be able to get this in every day, right? And having these goals and realizing, wow, I thought I was going to be able to do that, but I'm now realizing it's going to take me months or maybe a year before I'm going to be in shape enough to do X, Y, or Z, right? So they're beginning to wake up to the fact that the things that really matter in life are things that you just can't go to the store and buy or can't just decide to do tomorrow. You've got to put together a long-term plan and then execute it mostly on a daily or weekly basis in your life to make it happen. This goes to the lessons of the Stoics, which we've talked about in past months, Lance, where it is all about the process. Ryan Holiday, he basically says, what you need to do is you need to adopt the behavior of the person that you hope to become someday. And even if those behaviors, even if they don't feel natural or you don't feel good at them initially, just start doing them. And slowly, as time goes on, you will become more and more of the person you're hoping to be by following these behaviors. And again, that's exactly what the routine, does for you. And then last, I just want to mention a kind of a time-honored axiom from fitness, right? Which I'm sure you've heard this, Lance. They say it's all about time under tension.
Right.
And that's basically a function of weight and reps, right? Which is if you want to build muscle, build strength, it's a combination of, okay, well, you got to move weight, and you either have to move heavier weight or you've got to move the same amount of weight more over time to build. And again, that's what a routine is doing for you. It's that time under tension. It's just you're depositing into that account again and again and again. And yeah, again, it might not seem like the sexiest thing in the world, but for all the reasons that you went through with your own routine, Lance, not only does it help you get to your goals, but it really is a life enhancer. And that's the main point I wanted to get to folks across here.
Absolutely. And look, a lot of people are going to say it's impossible. I can't do that. And again, it's always the case. Start small. Get a calendar, right?
Yeah.
And put on the calendar, I'm going to work out at 10 o'clock in the morning or whatever time you want to work out, and be religious about it. One good thing is if it's just using workout as an example, is I work out by myself. I'm disciplined enough to go to the gym to do it by myself. But if you're not disciplined enough to go to the gym, hire a trainer. And again, just to get started, hire a trainer. The reason is that even if it's cheap, it doesn't matter how much you pay them, but you're paying somebody to do something, so you'll at least force yourself to show up because you're spending money on this, right?
Right,
So,
right. Someone to help hold you accountable. Yeah.
yeah, and or get a good buddy that is going to call you and make sure that you're there at the gym. And when you try to weasel out of it, oh, I can't today, Jim. I got this going on at work. So, bullshit. Get to the gym,
Yeah.
right? This is time we set up. But figure out some way to hold yourself accountable to one thing, right? Just be accountable to one thing. And if you can do that, then you can be accountable to two things. And if you do that, you can be accountable to three things. And then you can build it over time. And look, I'm like Adam. I learned this the hard way in life. And it took a long time to get to where I am and to do my schedule the way I do it. It works for me. It works for my family. But you've got to figure it out for yourself. But just start small and make small changes. And I have a great fitness coach and health eating coach that I have dealt with for a long time. And his method about dieting is make better bad choices.
Right.
So, like if you're going to go eat a hamburger, get a hamburger with no mayo on it, no cheese. Right? Just still eat the hamburger. It's not great, but eat the hamburger, but just make a better bad choice. And that's the kind of, if you approach life that way, just by making better bad choices, all of a sudden, better bad choices actually start adding up to some pretty good choices over time.
Over time, yeah, exactly. And it is that overtime element. In this big but boring program that I'm following, to your point, Lance, it actually starts when you're starting at weights that are almost insultingly low. Right? But the point is, it's to get you that momentum, right? And to make sure that you get started. And it's over time, they slowly increase. And so, yeah, it may take a couple of months, but eventually you're like, okay, I'm actually moving some pretty big weight here. But you started at something that was totally achievable, right? So you want to start easy and set yourself up for success. And the research is really clear. The number one factor for success for people developing a new routine and sticking with it, it actually is a supportive community. So whether that's a trainer, whether that's a buddy or whatever, if you're not at the stage that Lance and I are at, where you've got enough momentum where you feel pretty comfortable, going solo, definitely get somebody, at least one person, into the mix, because that research says it literally is the most encouraging thing that you can do for your odds. Okay, well, look, it took a little bit longer than I thought it would, but I think it's a very, very important message for everybody, but especially folks, if you're younger, if you're millennial or Gen Z listening to that, please take it from us old dudes. The routine, the goal plus the routine is a total life enhancer.
Yeah.
All right, folks. Well, look, if you think that the biggest immediate enhancement that you can make to your life is to make sure you continue to watch Lance Roberts on this channel week in and week out going forward, let him know that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. No time like the present to start developing a really healthy routine for your financial life. If you'd like some help with that, highly recommend you work with a good financial advisor who takes into account all the things that we've talked about here today and on this channel in general. If you'd like some help doing that, feel free to schedule a free consultation with one of the financial advisors endorsed by Thoughtful Money, perhaps even Lance and his team there at RIA. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds. These firms will be in touch with you immediately after you do that. Also, too, while you're there at Thoughtful Money, don't forget to click the newsletter link at the top of the page to sign up for our free Substack. And just a reminder that the Substack price is going to increase at the end of the year, so in about a month. If you are a current paying subscriber, don't worry, you're going to get grandfathered in at whatever rate you're paying. But if you aren't yet and thinking about upgrading, do it now so that you get grandfathered in at the current price. Lance, as always, my friend, I'll let you have the last word.
I know you're going to see this late, but I hope, wishing you a very happy Thanksgiving. And
Thank you,
by the
buddy.
time you're seeing this video, I hope you and your family had a wonderful Thanksgiving holiday. And we're getting ready to go into the best time of the year. And I'm not politically correct by any stretch of the imagination, so I'll be wishing you Merry Christmas when we get there. So just be aware that's coming closer to the holidays. So, but I really wish y'all all the best, and thank you so much for watching. And we'll definitely see you next week.
All right, everybody. Echo Lance's sentiments. I hope you're having wonderful holidays of all stripes, Thanksgiving, Christmas, whatever it is you celebrate. Look forward to seeing you, Lance, here through the rest of the year, as well as everybody else viewing. Folks, have a great time. Thanks so much for watching.